Justin is run by a bunch of investment bankers, and Morningstar's modus operandi.
Hello, I'm Brett Horn, Associate Director of Equity Research here at Morningstar. We've got Berkshire Hathaway's annual meeting coming up this weekend, so I invited Bill Bergman, our analyst who covers Berkshire for us, in to talk about what we might expect to hear about. Thanks for joining us.
Hi, Brett. Nice to be here.
We talked about a couple of topics. One topic I kind of like to hit is operationally. It's Buffett draws a lot of press for his trades and his investments, but Berkshire Hathaway is a large operating company. They've got a lot of businesses that are some very exotic, some very pedestrian. One thing in reading his letter this year, I was actually kind of surprised to hear was, he was talking about how they're actually attracted to capital-intensive businesses at this point. Now, given our philosophy, that maybe raises a little bit of flag. All else equal, as capital goes up, ROICs come down, returns to shareholders and value creation would come down. Is that something you're worried about?
Well, I don't know if worried is the right word, Brett, but it's something that is a reality, I think, for Berkshire in this stage in its development, which is a long history of acquiring firms at a relatively good price and compounding returns over time for shareholders of Berkshire in ways that haven't been replicated elsewhere in our corporate universe. But having said that, yes, the size of the firm and its cash position as well as its capital structure are making the firm more attractive as a merger partner for capital-intensive business, as was exhibited by the Burlington Northern acquisition. One attraction for the Burlington Northern acquisition for Berkshire shareholders as well as Burlington Northern may be the marriage. You have a capital-intensive business in the form of Berkshire in Burlington Northern, but you have a low cost of capital at Berkshire Hathaway in ways that may be good for both entities.
Is Burlington really, a game changer for Berkshire? Is it just kind of one more business under the umbrella, or how do you view that?
Well, it is a game changer in terms of the size of the transaction. I think it really is fundamental. We don't have pro forma statements yet. They're going to be very different just because of the size of this transaction, I think. It's going to be an important material mover in terms of the book value per share. One issue going forward here is looking at the change in the book value per share at Berkshire in the year ahead, and whether or not this acquisition, thinking about the contribution of this acquisition, once it's added to the book value numbers for Berkshire Hathaway, that's how big this transaction is. It makes sense to be thinking about how big it is relative to the actual. Berkshire likes to look at the change in book value per share as an indicator of the economic growth for the shareholders during the year ahead. But there's going to be some interesting issues associated with this transaction.
And I guess, keeping on Burlington for a section, one of the sections that kind of caught my eye in the annual letter was, maybe apology is the wrong word, but, he felt the need to explain why they paid partly with stock, and kind of drew out that this is not something, it's not something historically that they've done. And it seemed like maybe he had a little bit of misgivings about that, or at least felt the need that he had to explain why they did that. Is that a flag for you at all, that kind of change?
It was a flag initially, and I've thought about it, and I think over time, I think the fact that they were willing to pay stock at this price is something that may reflect actually the value of Berkshire Hathaway's stock to the Burlington Northern shareholders, and the way that the shares were split as a consequence of reducing the tax consequence of the transaction for the Burlington Northern shareholders. I think that was part of the overall attractiveness of that $100 per share consideration, which is something that actually is probably viewed, I think, at least neutral or better for Berkshire Hathaway shareholders.
Okay. And I guess going back to the existing businesses, Berkshire is known for generally as a financial institution, but the reality is, in terms of contribution, that there's quite a range of businesses under the Berkshire umbrella, and a lot of them are very economically sensitive. What do you see if we do get into an economic recovery this year? What does that mean for Berkshire's results?
It is easy to think about Berkshire Hathaway as a mutual fund. A lot of people think about that, but no, it's a collection of real, honest-to-goodness bricks and mortar businesses. At least half the fair value could perhaps are these operating subsidiaries, which are in a wide variety of industries, many of them very economically sensitive. And firms, I'm just thinking of Forest River, a manufacturer of RVs, very consumer discretionary spending to the max.
RVs sensitive. Are not necessarily something you think about when you think about Berkshire Hathaway.
RVs, Acme Brick. You don't think about bricks as something that's in Warren Buffett's portfolio, but it is. It's a brick manufacturer that's very sensitive to trends in housing and residential construction. You've got Shaw Industries, a maker maker of flooring systems and carpeting that's very sensitive to housing. And there's other variety of different, the furniture companies that are within the Berkshire operating subsidiaries, and Iskar Metalworking, a metalworking company that's very sensitive. A large swath of those operating subsidiaries are very sensitive to the economy, and they've been dragging results in recent years that may be turning in ways that if we combine a good insurance year and a good investment year for Berkshire with a recovery that looks to be developing in those operating subsidiaries, we've got a pretty good increase in book value per share this year.
Okay, great. Well, on that note of optimism, we'll end it there. Thanks for joining me, Bill.
Good. Nice to be here.
I'm Brett Horn from Morningstar. Thanks for joining us.
At Morningstar, we feel it is important to schedule regular checkups of your investments. This is the reason we're pleased to announce Portfolio Monitor, a new and easier way to keep track of your investments. With a few clicks of the mouse, receive a monthly report that provides a comprehensive and customized summary of your portfolio, sent automatically to your inbox. Portfolio Monitor provides a concise digest of all the best features of premium membership. Become a premium member with our 14-day free trial to start receiving Portfolio Monitor today.